Hi there, and welcome to another exciting session of training provided by Quicksoft. You can contact us for any training needs or doubts you have by sending your email at contact@quicksoft.com. In today's session, we have a multi-series videos where we'll be covering consolidation from start to the end. Because the chapter is so big, so we have broken down into multiple series. There, I will share with you various options which you can look for consolidation, and especially you talked about certain gap adjustment and all that, right, which in your last discussion which we had. So I'll share with you, if you have multi-gap, multi-accounting regime recording, how do you meet that requirement? Yeah.
Okay.
So we can
Yeah.
meet that using primarily some categories and some certain stuff also share with you on that. And then as you mentioned, as intercompany, how do you want to handle intercompany? I'll share with you the approaches of the intercompany. Some people use a single account, some people use a double account. Yeah. So when I say single account, that means for my intercompany receivable and payables, I have only one account. And some people use two account, one for receivable, one for payables. What you should do, what when you should do, I'll share with you the advantages and disadvantages of each one.
Mm.
And then finally, your key thing which you want to learn is, if I have global consolidation and I want to do intercompany elimination, how we can do that, right? Because this is something
Okay.
which is done very differently as compared to those who are familiar with EBS. Yeah. And then finally, we come to consolidation. Consolidation in uh, Fusion can be done in two ways, because as you know, Fusion now has much richer reporting functionality as compared to EBS. EBS, we had only one reporting tool, which was FSG. So in consolidation, you can do two kinds of consolidation. One is physical consolidation, which we also call sometime for global consolidation, we call step consolidation also. And we can also do report-based consolidation without doing any physical consolidation. So what is the difference and how we can do that? I will share with you that. And also, as I spoke about the IFRS and GAAP difference handling, what are the differences? I'm not covering that in this particular call, because that requires more detailed accounting discussion. But I'm just going to cover, if there are differences, how you can provide a solution to your customer so that you can meet their requirement. Yeah, so that is my main focus. For example, see, again, from system implementation perspective, right? When you do implementation, when we, especially financials, when it goes to core accounting principle and core accounting discussion, that is where generally people have the subject matter expert guys who are generally chartered accountants and all that, who can discuss with the financial control at their level. But from system implementer point of view, we tell them, okay, if you have your core book in IFRS and you have to report in US GAAP, how I can give you a solution you can meet your requirement. What accounting?
Yeah, that is also fine.
Yeah, what accounting journal entry you pass, how many you pass, we leave it to you. Which we give you solution to meet their requirement, right? So that's what I'll focus on. Yeah. So assumption, because I've done this setup, and it took me almost 6 to 7 hours to do all this setup to show you complete cycle. So the assumption which I've taken is, we are looking at it because generally for global companies, at least, yeah, if you want to simplify consolidation, you should have a single chart of account. Yeah, that is where the core thing starts. You can have multiple, but then it becomes more and more complex. But and we'll have different functional currencies. uh, in each country. Every country will have their own functional currency as required, which is fine. Some country can have calendar year as a accounting calendar, and some can have financial year as accounting calendar. This is one of the requirements which you wanted to cover, right?
Yeah.
And if we have this requirement, how do you do consolidation? I'll share with you also two different aspects on this one. Yeah, and then I'll show you consolidation process for a month. And again, as we discussed, this is not a hands-on session. This is more of a sharing session with you, where I will explain you all the concepts in detail so you understand. And then maybe later when you need, you're able to implement those solutions.
Okay, sure. Let's
Okay. So before I go to system, right, I need to explain to you a few things so that you understand that how it works. 1 minute. Okay. This is basically the setup we have in our system currently.
Okay.
I have defined three ledgers, primary ledgers primarily. I'll talk about these two later. I have three ledgers. Let's say ledger Singapore, ledger Malaysia, and ledger US. Okay. Singapore currency is Singapore dollars, Malaysia is Malaysian ringgit, and US is US dollar. Okay. My Singapore and Malaysia have an accounting calendar which is Jan to December, but my US has an accounting calendar which is April to March. Yeah, and they are all sharing common chart of account, which is a 4-segment: company, account, cost center, and intercompany. Yeah.
Okay.
And this again, just a remark there. You understand the intercompany concept very well, right?
When intercompany, I mean, yeah, I know, like, but you can go with your flow, you know, like.
Yeah. See, basically, again, just sharing a bit on a chart of account. When you define chart of account, right? And you can have define your chart of account segment qualifiers, which you say this is my natural account company or my cost center, and also intercompany. Right. Yeah. So when you define a segment as an intercompany, by default, system will try to take your value set which is given for your company segment.
Correct.
Right. You understand why we should take that and why you should not take that?
You can explain me that, why we should take.
See, yeah. The easiest option for people when they say I have my company segment and an intercompany segment, actually they're both talking about the balancing segment, same value set, right? The easiest option is people can take the same value set. Yeah. But the problem comes because I could be working in one company where I have only access to 2 balancing segments. Yeah. Whereas intercompany I can do intercompany in multiple companies.
Right.
So security control perspective, then it starts giving the problems. So it's always, when you're defining, if you are defining a new chart of account and your opportunity, it's always define intercompany as a separate value set, which could be same as your company value set.
Okay.
Then you have, because then you don't want to put controls on those. You want to put, but you have a choice to put what kind of control you want on the segment. You don't want everything what you put on balancing segment gets automatically applied on intercompany segment. Yeah. So it's always advisable to have a separate intercompany segment value set. The values will be same, but you will have more control.
Right.
Okay. Now these 3 ledgers, this is the core setup. Now we talk about next 2 ledgers. These 2 are also defined as a primary ledger only. Because ledger is the ledger, right? It doesn't. Right. Or how we use that ledger is a different thing. But ledger, from system perspective, is a ledger. Yeah. I defined a consolidation ledger in US dollar. And I want to do consolidation in financial year is April to March, and my calendar is same.
Okay.
And I've also defined an elimination ledger, which is US dollar, and calendar is also April to March. What is the difference in calendar when we talk about calendar, right? Why we talk say calendar year and financial year? What's the difference in these 2 calendars? Yeah. Yeah. The key difference when you talk about different calendars is, right, in this example, the good thing is we are talking about month as a period. Whether it's a calendar year or as a financial year, the period is a month. Right? Some organization have a various variety of period, then it becomes a different story altogether. But in this case, at least we're talking about month as a base period. And then, but the year is a different calendar or financial. The key difference is that, when the moment a year changes, yeah, your P&L accounts become 0 for the first period of the next year, and the difference of the last period of P&L total year moves to retained earning account. Correct? Yeah, that is a standard thing. So when we talk about different calendar, we always say, okay, my in my this books, when I go to Jan of next year, my P&L will be 0. In my this book, when I go to April of next year, then my P&L will be 0.
Correct.
Correct. But we have to consolidate this together. How do we do that? Yeah, that's where I'll share with you the different approaches which people use. See, when you do consolidation, what is your goal? Yeah, so what you're trying to do is you're saying, when I do consolidation, take balances from this ledger, put into my consolidation ledger, everything in one book, then I can report together.
Right.
Correct. That is one way of saying that. Other option could be, I can say, just take all these ledger independent balances and I can print on the report and sum together. That is also consolidation.
Yeah.
Right. So the consolidation meaning doesn't mean I have to have ledger. Consolidation mean I have combined the records, combined the data, and present together.
Or you can create a ledger set, right?
Yeah. That's what I'm saying. It's a presenting. Yeah. But because why people use various options to do consolidation, because sometimes they have multi levels of consolidation. For example, there's a company in Singapore which gets consolidated into India, and then for India consolidation gets consolidated into Europe into maybe US, then multi levels of consolidation. Yeah, so people do that. So what the key thing which we want to achieve from this one is that when we do consolidation, we put everything into one book. So my data is in one book, my reporting, everything becomes much more simplified, and I can do whatever I want. And when you do at this level, you can actually do elimination entries in this book as well. So when you do consolidation, when your calendars are different, what can you do? Yeah, as I mentioned, the key difference is the retained earning, right? So now when I do consolidation, how do I overcome this situation? Okay, so when I do consolidation, right, if all three books were same calendar, was no problem. Now we have different calendar, so then we have to go back to the approach how we do consolidation. Consolidation you can do in two ways. You can do PTD consolidation or you can do YTD consolidation. Yeah. Now, if I do PTD based consolidation, yeah. So if I am in, my calendars are different, and when I'm doing PTD consolidation, that means when I do PTD from my Singapore book, I'm moving to my console book. Let's say April 19 balance, right? When I do this one, will this give me any problem? Whether my calendar is different?
From April 19 to consolidation. Consolidation is what? April to March, right?
Yeah, but I'm moving my April balances to April in consolidation. April period transactions balances, yeah.
From Singapore, right?
Yeah. Will this give me any trouble?
You know what? I don't think so.
You don't think so, right? That's the right thing, because I'm moving from one period to other period, just period transaction, no problem.
Yeah.
Right.
Yeah.
Now, if I do, sorry, this one, will this give me any trouble? I'm doing YTD.
Yeah, YTD, I think YTD, you know what? When you are doing YTD, when you are giving YTD, I think yes, it will. I mean, because your retained earning account and those accounts will be different, right? At the trial balance level.
See, as I mentioned earlier, right? What's the difference? Difference is when your P&L will become 0.
Right.
Right. If I do YTD, when I reach Jan, this calendar is still not finished yet, and this calendar will make my P&L 0. And when I do consolidation, suddenly my balance sheet is out. My P&L has become 0. Right?
True.
So if you're doing PTD based, then it doesn't matter, right? Whether calendar becomes, even though in Jan this opening balance becomes something whatever, but I don't even care what opening balance is. I'm just picking PTD transactions. So this will work, right? But this will not work. This is one.
If we do in the YTD. Not.
Yeah.
Right.
Yeah. For YTD, you need to do a few things, but to simplify what organization do, which I'm going to share with you in our next process, even recommended by Oracle. Yeah, they just want to get your thought process going. That's why I shared with you this example. Yeah. Now, what is advisable is they're saying when your calendars are different, then you define secondary ledgers in same calendar where you want to consolidate.
Oh, okay, got it.
Okay, so I define a secondary ledger for Singapore, which is coming from a source ledger Singapore, the original one. Currency is same secondary as the original one. My calendar is different. My chart of account, everything is same. So for these two books, I define two secondary books. Later, I'm going to show you complete setup in the system, that how I've configured everything. Yeah. So now, when I define this
so
one,
you are taking an advantage of. Okay.
yeah. So what happens is, whatever transaction I do in Singapore book will move to my secondary book, Singapore secondary, right? And then because of my calendar is different in this book, it will automatically help me align with that my consolidation and calendar. Right. Yeah. So we're simplifying the things here. Yeah. So now when my secondary, I can do conversion at journal. I will talk about conversion levels also shortly. Yeah. So this is my secondary book in this calendar. So once I get this secondary book, basically I'm saying if I take this book, and this book, my consolidation becomes very simple. Correct?
Okay, can we let me understand that? Like, see, we have a primary ledger that is Singapore VH ledger SG. That calendar is January to December, and currency is Singapore dollar. Now we are doing the consolidation, and in the consolidation ledger, we have the April to March. Now, since we do need to report the, reporting in the consolidation ledger, that is April to March. So we are taking an example, advantage of secondary ledgers.
Correct.
Where we are saying that, okay, my functional currency is same, my chart of account is same, but calendar is different.
So basically what I'm slowly to get my consolidation done. What is my consolidation currency? US dollar, right? So currently my differences are my currency is different, my calendar is different, correct?
Right.
I've done first step. I've aligned my calendar.
Right.
Okay, my 3C, famous 3C.
Oh,
right?
okay. Got it. So first you're aligning the.
I'm trying to align all three.
The same currency.
Step by step, I'll align all three. Once all three, then life is very simple, right? So
no. I got the clue now. Yeah.
Correct. This C is fine. This C is fine. This C is still different, right?
Yeah, and yeah, got it.
So your secondary ledger is clear, right? Now I go next step. Now when I want to do consolidation, I have multiple options again. Again, this depends on the client's requirement, Rajesh. When you talk to them, what their requirements are. Yeah. One simple option could be at the month end, I translate balances from these books because my consolidation is in US dollar. I translate into US dollar and then balance level I consolidate.
Yeah.
But some organization nowadays, actually many organization are doing reporting currencies. We also call reporting ledger. Now in Fusion, these are called reporting currencies.
Yeah.
So what they do is they define reporting currency. In my example, for my each secondary ledger, I define a reporting currency.
Correct.
Yeah, in US dollar. So that every transaction I do here, and I'm also doing a journal level. I'll discuss detail what level you should do, but I'm also doing journal level conversion. So any journal I post here, will go to secondary. Any journal posted secondary will go to reporting in US dollar, will be converted based on the rate as defined in the ledger setup. I've told you consolidation can be done in two ways. Let me go here. When you do consolidation, I can have a ledger in Singapore currency. I can have MY currency, and my consolidation is in US dollar. Right? So one option is monthly basis. I just do translation of my balances, and then I do transfer to USD. That I'm doing TB level.
Yeah.
Okay. But Other option is, if I want to do journal level, that's why I was going to cover this later. When you define journal level, then system, every transaction you do, every journal you post here,
Oh, okay,
relationship,
okay, got it.
automatically journal goes there. You just have to post it. Auto post can post it.
Okay, maybe I was talking at the balance level. The balance level,
Yeah,
I
yeah,
think we have to
yeah,
manually do.
yeah. We are talking about balance level. Yeah,
Okay,
as
got
I
it.
mentioned, I'm going to cover this shortly. But here I'm talking about journal level.
Okay, got it.
Yeah, and I'll also share with you why you should do journal level. Okay, so now they have a relationship. When I post here, journal goes automatically here. When I post here, journal goes automatically here.
Mm-hmm.
Right? So now if you look at our journey, we started here with currency difference, with calendar difference, but our goal is to get all these three seats same, to simplify. Now at this stage, if you see, my 3C are same. My this ledger,
My 3C are same
for
with the
for my,
consolidation ledger.
yeah, for my these two, Singapore and Malaysia, and my US ledger, all these 3C are same.
Mm-hmm.
Yeah, so my consolidation becomes much more easier now. It's like
Yeah.
it's talking about, if I move all these three data from all these three books into this book, my consolidation is beautiful,
Mm-hmm.
right? So
Mm-hmm.
if you notice the steps, I have just moved from my aligning my calendar to aligning my currency, and I at this stage I'm now, my data is ready for consolidation book.
Okay.
Clear, right?
Yeah, I have one
Hmm.
question.
Hmm.
What are the challenges like mostly people feel in consolidation? Like, did you feel any challenges like in consolidation? I know like conceptually, I understood this thing,
Hmm.
but are there any challenges faced like when we run the consolidation during month end or year end? Kind of,
See,
if you like to
the,
share.
see the I again, for consolidation, right? In financial accounting or in GL implementation, the fundamental and most important thing is this thing:
Okay,
your chart of account.
correct.
People do not design their chart of account as per the, because why are we doing consolidation? Because of reporting, right? Yeah, they do not think in detail that how I'm going to report, and they design their chart of account not in that line. The consolidation, they can combine the data, but then the reporting becomes even more difficult for them. Yeah, so when you're designing chart of account, then at the time you have to think about your maximum level of reporting, your
Yeah.
highest level of reporting. If you think that in line and define chart of account, then it becomes seamless for you everywhere. That is what I talked about initially as an assumption, common chart of account. Yeah, but in many scenarios, because the
Mm-hmm.
companies nowadays, people acquire so many companies, right? So they have different trial balance, different currency, calendar, chart of account. So then you have to do all the mapping in a system. That is one issue people generally face. You have to
Mm-hmm.
continuously, because they every time add some new account, and all these problems they face in consolidation. Second problem people face in consolidation is, in especially which you highlighted earlier also, intercompany. Yeah, people do
Okay.
not use intercompany transaction process in Fusion. Only even in EBS they have that. They don't use the process. They actually create a manual uh, journal or debit note in their system, record it, and send a paper document to other company never records it.
Yeah.
Yeah, and then you have an intercompany reconciliation issue, and then they spend so much time reconciling this, they waste time on this one, which doesn't help. Whereas if they use AGIS process, yeah, and then they can do easily, if the transaction will be approved only if it is approved by both the parties, only then it will be recorded in your books, otherwise not. And when
Okay.
that
Okay.
happens in intercompany transaction, you can actually see my videos online available on intercompany transaction.
Because can I ask you one question out of this topic?
Hmm.
AGIS, right?
Hmm.
Why we need AGS if why we need AGS first of all, like selling sales perspective, right?
Hmm.
Let us say if I go to a customer, right?
Hmm.
We talk about okay, they want intercompany, like to be perform in their business.
Hmm.
They can say that okay, I can do the intercompany, at the GL level, right?
Hmm.
Instead of buying a AGIS. So
AGS
what is
you
the
don't have to
selling
buy.
selling
AGS is
perspective?
okay. Two things. AGS you don't have to buy separately. AGS now is part of the product, intercompany transaction. Yeah. So
Uh-huh.
AGS, once you have a, it's now called intercompany accounting. Yeah. For a customer, right? Let's say if you talk to a customer, you say, uh, most of the customer who are new, right? The traditional way of doing intercompany is what they do. Traditional way, they will define if they have 10 companies, right? 10 companies they deal with, right? Let's say company A, B, C, D, E, F, G, H. There's so many companies, right?
Yeah.
So they create intercompany. They create intercompany accounts for each company, right? And when they post a journal in their book, they will say, okay, I'm debit intercompany A and credit whatever bank, whatever they make some payment, right? So $100 they need. So once they do this one, they post this journal. They have already updated their books, right? Now this is my, let's say I'm company Z. I'm company Z, right? Now company A has to post the same entry, has to book their expenses, whatever 100,
Yeah, debit
and they will say
expense.
credit intercompany to Z.
Yeah.
Right. Now this entry, when I did this one, I sent an email or some debit note to company A, correct? Because I paid some money on behalf of the company A, so I'm basically collecting the money from them.
Yeah.
Now company A has to pay me back, and it's actually their expense. They have to book their own expense, correct? Then if they both do this one, and when end of the year or end of the process I do elimination, I'll find for my this entry an opposite entry here. For elimination I can find it. But most of the time what happens, this entry is missing. So when I do intercompany reconciliation, I find left side but right side is missing.
Right.
So then they call this guy, say, oh, I sent you this debit note, why you have not done anything? This guy says, oh, actually this issue, that issue, I don't agree with your debit note, I have some problem and all that. Then the discussion starts. Right? And then what happens is month end is delayed. That's why some companies, you notice, their month end takes 1 week or 2 weeks. So some even take 3 weeks to close their month. So by the time they close the previous period, next period almost ready to finish. Whereas with the ideal scenario, you should be finishing all this in 2-3 work days. Yeah. If you notice any company, you talk to them how many days it takes to intercompany reconciliation, especially for bigger company, they could be taking weeks.
Yeah, true. So because here, like in the company Z, right, debit is intercompany A, credit is this. So by the month end, right, they have to like clear that balance into the intercompany, right? So they just put the credit entry there, right, just to nullify that.
Yeah, because from accounting principle, right?
Yeah.
We are two companies and dealing with each other. I keep selling it to you. I keep showing my revenue from you, and you keep showing expense to me, and I keep inflating my balance sheet because these are balance sheet accounts, right?
Yeah.
Yeah. I keep inflating my balance sheet, and I show I have to collect you 100 million from you, and you have to pay 100 million to me. My asset, your liability within the same company. Yeah, so that's why within the as per intercompany accounting guidelines, which for any within company transaction, you should eliminate.
We should eliminate, right, with the credit passing the opposite entry.
Oh, passing opposite entry. Okay. Yeah, but I should pass only when I find this entry.
When I find this entry means
they have to reconcile first.
Right. So ideally, if you don't have AGIS, so you have to pass that entry manually then, right?
Yes. Yeah. So if I have AGIS, when I create this entry, you have you used AGIS before?
Yeah, I did set up.
Yeah. So you watch my intercompany video on my YouTube channel. Intercompany transaction. It gives you it's around 1 hour video. It gives you step-by-step instruction of implementing intercompany and also shares a lot of detail about intercompany.
Okay.
Once you see that, you don't have to ask any question after that.
Sure.
Yeah. So you what happens is this company, when intercompany transaction you do, when you create this entry, this company A receives a notification that company Z has sent an intercompany request for you. Do you agree? Only when this guy approves, if you enable approval, this guy approves, then the entries are recorded in both the books. This book will create if you have invoicing enabled, for example, for intercompany, this will create an AR invoice. in this book they'll create an AP invoice.
Yeah,
If you have
expense. Yeah.
invoicing not enabled, then it'll create a journal in both the books and automatically balance for intercompany as well, whatever required.
Yeah. So usually when I pass intercompany at GL level, so I pass this entry, right? Whatever is your row number 20 and row number 23, no, row number 22. Then intercompany system will automatically create.
It will balance, right? That is the balancing entry.
Yeah, that's the balancing entry.
Balancing intercompany balancing entry. Yeah.
Yeah.
So
Yeah.
Again, the point here is to understand why to do a normal foresight, what people do generally, and why to move to AGIS. The purpose of AGIS or infusion called intercompany accounting is to eliminate half transactions. Either it is there with that process, either it is there in both the books or not in any of the books. So end of the year or the end of the period, you will not face any reconciliation issues.
So that is the purpose of AGS.
That is the main purpose. Because otherwise, I send something and then this account I don't agree, or say, oh, you never send me this attachment. I need the support. I need this. I need that approval. All those, typical accounting processes. And so because of that, the things get delayed. And now, unless that is resolved, I can't close my period. Right? That is why intercompany also have a separate period. Intercompany accounting. So I can close intercompany period earlier. Let's say 25th, I close my intercompany period. That means after that, no more intercompany transactions are allowed for that month. If that issue is resolved, that means I would have done my reconciliation, everything done by 25th, 26th. Then when I actually do my month end of the month, I don't have a problem.
Okay, got it.
Got it, right? So this completes the part 1 of consolidation. If you have any questions or training needs, please feel free to send your email at contact@quicksoft.com. Please remember to click on subscribe button so that you get notified whenever a new video is published. Remember to watch the part 2 of this video so that you can understand consolidation very well. Thank you very much and happy learning.